The market is looking green today ahead of a slew of earnings in the tech sector coming up. We'll be discussing that, everything going on with crypto, and much more today on Money Never Sleeps. Thanks for joining us today, everybody. Before we get going, do us a favor, hit that like button, subscribe to our channel, and remember, nothing we say is financial advice, so please do your own research before making any buys or sells. Kev, welcome back. I hope you had a good weekend, had some quality time with the family, myself, feeling recharged and energized, heading into a big start to earnings season.
Yeah, man, I'm glad to hear that, and I'm also very excited to see what these next few weeks bring. We got some warning signs out there, which we'll talk about today, but I think everyone's mind right now is on the market just being green after one of the worst spans in months for the market. It was just nonstop red, and then Thursday and Friday night we weren't didn't do the show. It was absolute chaos. People weren't sure how the markets were going to open. S&P was down almost 90 points at one point. Dow was over 500, but it looks like they're buying it back here. So I'm very interested to see how these earnings impact price going into this week and next.
Yeah, we are seeing it being bought back. We had the Bitcoin halving over the weekend. Crypto has been relatively strong ever since then. No crazy volatility there. I personally was expecting a little bit more movement to the downside, but it is what it is. We have earnings kicking off. We have Tesla earnings after the close of the markets today. We have more big tech over the coming weeks. We'll also have some key inflation data later this week as well. We get the PCE data on Friday. Nothing yesterday. We've had a little bit of manufacturing data today that came in below expectations by a little bit. New home sales data came in higher than expectation and higher than the previous month. So interesting to see the data coming in on that one year over year. And we'll find out, like I said, more about GDP on Thursday, see more about, inventories and trade balance. So a lot of data on both the economic side and the stock side of things. So excited for all of that, what's going to be going down. As we look across the markets today, we see pretty much green everywhere in TradFi. The dollar is down. The VIX is down over 6%, way down from the high of 21.3 that it put in on Friday. We're seeing this rally in equities after the sell-off that you were discussing last week. Do you think it was just oversold? Is there some renewed confidence that earnings are going to be better than expected? What do you think is driving this movement to start the week?
For sure. So first thing, obviously, I was a little bit early when I said that we were going to get that VIX crush. I said that we'd be back into the 15s, into the 14s, possibly when we were trading around 17, 18. They waited till after OPEX. Okay, so that's one thing that we have to keep an eye on, which tells me that there's kind of a pattern that's playing out here. But for the most part, the market is extremely oversold, right? On the daily. I'm not saying that the market. I honestly think the market's still extremely overbought on a different time frame. But let's just pull up the S&P right now because I want to show people something. This is the S&P on the weekly. Obviously, it's rolling over pretty good. We had a nice move to the downside. It's bouncing here. You can see that it's coming to the oversold fairly soon on the weekly, just because it's been red for 3 weeks. It doesn't give me renewed confidence that we're going to see it bounce from here on the weekly. But when we look at the daily, look how far below we came the 50 moving average. The 50 moving average did not hold as support. So that tells me that it's a bit more bearish than people probably anticipate. Now, this rally into the 50 moving average, that's a pretty good move, right? I do want to check one thing real quick with what happened in 2020 to see if we got something similar to that. I don't think we did. I think we had this kind of move, which is kind of what I'm anticipating, where we have this nice little rollover and then we find support on the 50. And once you find that support, kind of bounces up a little bit. And then, maybe we'll talk about the warning signs in a few minutes, but we kind of look for this gap down where just the 50 doesn't hold once again. So we're waiting to see today, and probably by the end of this week, we're going to find out if the 50 moving average ends up holding as support, if we break above it. But for the most part, that's a really good move to the downside that we had. So I understand why people would be buying down here, right? You're going to have to retest the 50 at some point. If it doesn't hold, you're going to get rejected, and that's probably a sign for a lot of people to sell. The other thing is if you go above it, then maybe that's going to hold a support, and this was just a small little correction. And that goes for everything across the board, but the Dow and the NASDAQ as well. And NASDAQ's got a little bit more climb. Now, where I think it gets kind of problematic is there's these things called CTAs, which are pretty much computers that are trading the algorithms. So if it gets to a certain point, like hits their stop loss, then they're just automatically selling, right? And we were very close with this move to the downside, where had we moved down maybe another 100 points or so in the S&P, or a few hundred points in the other ones, there's a good chance that we could have seen a massive sell-off. Corporations are not here to buy back. We know that they're going to start buying back starting May 1st. Supposedly they're supposed to be buying back starting May 1st. We'll see if they actually do. Earnings and all this stuff is going to be really important to seeing if they want to buy this back. But for the most part, I think that this is a pretty good short-term rally that we're going to see maybe for a week or so. That kind of makes sense. And then maybe we can reassess what happens afterwards. But I'm not surprised that we were seeing this rally. I was a little bit early. I think we were talking about it a few episodes ago, how there was probably going to be a rally coming in soon.
Yep, we got the rally. It is here. How long it goes for, how high it climbs, we are not sure about that. Let's look over to the oil and gold side of things, because we've seen some kind of mixed signals over there. Gold put in, a new high, briefly touched over 2,400, but it put in a new high around 2,392 back on Friday. We see a little bit of move down. It's pretty much flat on the day. Bad day yesterday, but we're starting to see, maybe where the party has run out in the gold area. Peter Schiff could be eating a little bit of crow with all the victory laps he had been taking on Twitter. But what are you seeing there and with oil, and how do you feel that's going to impact things moving forward?
Definitely. So I think this is one of the warning signs that I was alluding to. When we look at gold, it's had a massive rally, right? I mean, this is an amazing rally from October 2022 all the way to here. And a lot of this is because of inflation concerns. People are afraid of inflation, but it really had a good move since February. It's been nonstop since February. Let's see. To the height, went up 22%. And Peter Schiff has been, barking this whole time that gold that beats the shit out of Bitcoin, and every chance it gets, that inflationary, when it comes to inflation, gold is the hedge. I think he's wrong. I agree with him on a lot of things, but he's definitely wrong in this. And this was the level that we wanted to watch, this purple line, because when we look at this in a historical context, let's go to the monthly real quick. This is held pretty strong. Every time you get to that purple line, you get rejected from it. I mean, we did go below it yesterday with that move and that candle. We have to start seeing how the closes are. We're extremely overbought on the monthly time frame as well. I mean, you're just finding resistance in quite a few areas. Let's see the Bollinger Bands too. Bollinger Bands, now they're breaking out a little bit. Maybe on the shorter time frames, we'll see something kind of, this is kind of what I want to see here. So what we're seeing on the Bollinger Bands is that they're coming in here. So I would anticipate that we're going to see a pretty good move in gold on the daily at some point. Whether that's to the upside or the downside, remains to be seen. I think it's more likely that we're going to see greater moves in gold to the downside than to the upside. But that's just my personal opinion. And we can talk about the dollar, how that leads into it. But when I'm looking at this with gold has been extremely strong in this rally since February, right? You would think that gold miners are also doing extremely well, but they're not. Very different chart. This is gold. This is Barrick gold, right? Obviously, very different scenario when you compare that to gold. Let me see if I can compare it to GLD, or what is it? Gold. Just gold as is. Same percentage scale. You can see, actually, no, that's a terrible, forget that, guys. But you can just see when I go back, it just, I don't know, same percentage scale sometimes doesn't give you the good picture. But you look at gold, how much it's rallying. I mean, this is pretty significant. Then you just look at something like Barrick gold, where it's rallying, but it's very, very small in scale. NEM, which is, I believe, Newmont Corporation, very similar, not rallying nearly as much as gold is itself. You got a little bit of a rally here in Hecla Mining, and then if you look at VanEck Gold Miners ETF, it's okay. Like, you're making money if you have it, but you're not making anything as if you were holding actual gold. When something that we've seen this before, well, it's actually very similar to something that we saw back in 2020, right before the crash in March of 2020. So what you're seeing is that people are afraid and they're fleeing to gold, but gold miners are probably not going to do as well until gold kind of finds that place where it's like, okay, this is an uncertain time period and it's going to rally. But I think gold has to crash first before the gold miners are going to follow. But this is a very much a warning sign that people and investors are afraid, so they're flocking to something that they think is a safe asset. And it just isn't right now. We saw in 2008 when gold started climbing, it crashed right when the absolute financial collapse began. We saw that the dollar rose and then gold absolutely just tanked, and it actually made the dollar stronger against a lot of other assets because people are selling into the dollar. Now, so that's something that we have to keep in mind. Now, let's go to the oil front, because the oil one is just as interesting. We were all talking about oil going to 100. Even I was, right? Has it topped? We really don't know, but there's a good chance that oil might be done here. Why is this acting all weird now? There we go. We were talking about oil going up to, above 93, making a higher high. I don't know if it's going to. We're seeing a bit of this kind of move to the upside. And if we look back at the beige book, the news that came out, they were talking about how inflation is caused primarily because of two things: oil and rent. And the funny thing is, we're not seeing rents necessarily become more expensive, in housing. But we have seen oil be extremely expensive, but it's not expensive for the reasons that we think, not because manufacturing costs or people buying oil or gas. The real reason is that we're just seeing conflicts in the Middle East. So that tells me that there's no demand in this move to the upside. And if the conflicts in the Middle East continue to be problematic, well, then maybe oil can stay up here, sustain this price level. But if there is no reason, there's nothing that's keeping this price elevated outside of that, there's a good chance that we could see the top of oil already put in, and we could see a summer months where there's just no demand and oil's price continue to just plummet over a cliff. I like to go back into history and look at this when we have these periods where it's just nonstop bad. Like, look at the summer of 2014, demand just dropping significantly, right? I mean, it dropped an insane amount for a period of time. And then you look back at 2008 as well, and this is obviously more probably in line with what we're experiencing right now. We're just seeing demand drop significantly. Unemployment is also probably at the same time rising with this into the point where we get to October, where unemployment starts rallying. And I say that as the percentage rate probably goes up for about a year after that. So this is also an indicator. If we start to see oil to roll over here, we're probably going to see a summer where there's going to be low demand. And on top of that, we're probably going to see a summer where there's a lot of unemployment that starts to pick up. I think we've already seen that. I think the earnings are also going to kind of be in line with that. And it's just a matter of how everything is tied together: manufacturing, oil, and then consumers. So one of them doesn't have money, it's not going to circulate into the others. That's the only way that we kind of see oil continue to push up naturally outside of these conflicts that we continue to experience in the Middle East.
I want to go into some data we got yesterday, shared with us by our good friend Mr. House, and I'm gonna screen share this post from Twitter. Nick Garley, I think I'm saying his name correctly, in regards to credit card defaults, because we had Discover report earnings, and they have reported a huge spike up in credit card defaults. Q1 of this year, 5.7%. That's a pretty big number. Now, if you compare that, he also over here to the left put up what they were back in Q1 of 2008, and from that point on up, from where they hit bottom right there at about 3.7% to the top at about 9%, we're on a similar trajectory here, heading back toward a 9% credit card default rate. That's crazy. Like, we know that people are in debt up to their eyeballs, unfortunately. We know that rates are going to stay high. I don't know offhand. I'd like to look at it, what the rates were around that time and when they started to begin to cut them. But man, like, that's a warning sign right there. I know that we've been bearish, and I know that the market has remained resilient, and maybe we're going to get this all wrong. But this is just one of the many warning signs, along with what we're seeing with commercial real estate, the stresses that are on the banking sector, that has me believing that there's still, like, patience is still the right thing to do. And I know it's tough when we're seeing, last week there was a lot of red out there. We're seeing a lot of green. It could get, tempting to be like, what, the rally is here. It's an election year, all these things, blah, blah, blah. But the warning signs are there. The cracks in the foundation are getting bigger and bigger. And that is what we are seeing when it comes to the stress that is put on the consumer. And I don't know what help they're going to get. I mean, there's a very real possibility that we don't see rates get cut this year. There's a chance that we even see them go up a little bit. And so, I try to look for data that both goes for and goes against my case. I'm constantly trying to question my thesis on all of this. But this is another one of those pieces of data that it's not the end all be all, but it is a slice of the pie, and it is a reason to be concerned.
Yeah, definitely. And just so everyone knows, it was right at the end of Q3, September 17th, September 18th, right around there, when the Fed started cutting rates in 2007. And that was literally the top when they of the rates, and then markets kind of rallied. And then right after that, you saw the down slope all the way to 2008. But it's worse now because this economy is absolutely just so leveraged in debt right now, especially, and consumers more so. I mean, you're looking at that; those charge-offs, those aren't bullish. I mean, it's funny to see Discover's price rally when you see data like that, but it just kind of tells you that consumers are in a fucked place. But the other thing is too, let's pull up the dollar because it kind of all relates, is that the dollar has been extremely strong and people are kind of telling are unsure. They're thinking like, I remember at the beginning of the year, everyone's like, no, the dollar's going to go down this year because they're going to cut rates. And it's like, well, they haven't cut rates and the dollar's been up only pretty much since the beginning of the year. And now we're starting to see the tune change. And a lot of these institutions that were bearish in the dollar, now they're buying dollar calls and dollar positions for the rest of the year. And they think that it's going to rally into 2025. And it's like, yeah, it was going to no matter what, if you continue to keep rates elevated, right? But this is something I want to show in the dollar. Obviously, it's been rallying. We're seeing a bit of a pullback here in the past few days, but what I'm seeing is kind of lining up with that thesis that something could happen in the next few weeks. And it's kind of lining up with February 2020, where the markets are reacting very similarly to set up for maybe a bit of an equity pullback. And I'm not saying that just because obviously I'm bearish, but I'm looking at this. And if I'm going to be a pattern trader, this is this is a bull flag or bear flag, bull flag, whatever. It's a parallel channel that's going to break to the upside. That's pretty much what I'm saying here. I'm bull flag, bear flag. Yeah. Again, it's because I'm bearish. I'm thinking it's bull. It's all bull, guys. But yeah, this is definitely a bull flag. It's gonna pop out of this, in my opinion, because something will happen, whether that's gold or whether that's the Japanese yen, meaning which we have to look at because that was been out of control. Once again, the yen has not come down. It is still up 154.79. They're doing a good job of keeping it around there. The Bank of Japan is meeting on the 24th, and they're going to be talking about the issues in Forex. Why is that concerning? Well, because we know that a lot of things could happen if Japan decides to, hey, we can't let the yen run out of control. Let's sell some of our U.S. debt. Let's try and get this under control. U.S. needs all that money to flow in the treasuries. They could see a massive sell-off into the equity market, right? There's a lot of black swans that are just, floating around there, and eventually one of them is going to catch. Now, looking at the Nikkei, which is going to kind of play into all this, we're seeing this massive pattern. Let's go to the weekly. Weekly's got a better chart. Right, we see this really good rally to the upside, all-time highs and everything, and then we got this major pullback on the weekly. Right, you see 3, 4, 5 weeks, and of those 5 weeks, 3 of them have been red. The 2 green ones have pretty much been sideways. But why is this important to look at? Let's remove these here, because when we look at this in context, we're probably going to see a bit of a rally here, which I am very much in line with, maybe for a week or two. But I want to look back at history. Because is this not the same thing that we're freaking doing here? Is this not the same point where we are? And then what happens next? This massive move to the downside. The 50 doesn't hold, and we're down at the 200, and we're hoping that the 200 holds. And again, same conditions as 1990 for Japan. The yen was out of control. Rates, they started to raise rates, and then you just saw the equity market absolutely pull down. So I'm very interested in seeing what happens here, because if that 50 doesn't hold, then you're coming down to the 200. And we talked about this a long time ago. Since COVID, we have all these gaps to the upside that have not been filled in the Nikkei. And it's a very possible situation where they raise rates, they try and save their yen. The equity markets are probably going to tank, right? That's something that we expect in a financial collapse. We've seen it in 2008 when the U.S. Equity markets collapsed, the dollar got stronger. The yen could get stronger here. It's very possible that the yen and the dollar both get stronger here, but that does signify that we're probably going to see a major pullback. And that tells you that maybe the consumer isn't as strong because, well, everyone's going to be scrambling for these dollars at that point. Yeah, that's the problem with the banks right now too. Rates remain elevated. These banks can't issue new loans. That means that there is a dollar shortage in the system. Means that people are probably going to be scrambling for dollars. The only way you can kind of get that is if you sell off equities and then kind of create some liquidity in there. But the system is getting very liquid, not just in the U.S. but on a global scale. It's very, very interconnected. It's very scary. Jamie Dimon came out today and says even if we go into a recession, there's a good chance that the U.S. consumer is still strong. It's like that's not true. That's kind of the reason why we're in a recession, because the consumer isn't strong, right? They're not able to buy the goods that are in order to keep people in their jobs and to keep people from to keep people spending money. We're seeing hours being cut, we're seeing jobs being cut. That doesn't sound like a recession where everything's okay for the U.S. consumer. It sounds like kind of just wishing one hand, shit in the other. Eventually, something's going to happen. And everyone's going to act like, "Oh, how could that? No one could have ever have seen this."
Jamie Dimon is so full of shit, like just completely full of shit. So I don't
He's wrong on this.
really, yeah, I don't, whatever. Let's briefly touch on crypto as we begin to wrap up today's show. Bitcoin, we saw the halving take place, I think like late Friday or Saturday or something, and continuing to see some upward movement there, right in the mid 66K range. We have the ETH that's gone on a nice little rally here, up at 3,200. Solana 158. So seeing things recover a bit here. Is this a bull trap? Is this a start of a rally up? I also saw some news around, the next batch of FTX's Solana tokens is going to be auctioned off. They're not going to be sold, directly into the market. So interesting to see how that looks. So last time they did it, price of Solana was like $80. So whoever was able to get, secure those SOL tokens is doing pretty well at this point. But let's go Bitcoin. We can talk Bitcoin dominance, and then we can start wrapping it up.
Yeah, absolutely. So here's the thing that's really fun. We talk about this chart all the time, right? And these highs that come in, and right after the highs, you see these major market crashes. I thought that the Bitcoin ETF was going to be kind of that scenario, and we kind of saw it for a short period of time, obviously being right around here. Came down to like 38,000. It's rallied since. But if we're looking at this, here's the IPO for Coinbase. Here's the futures ETF we got in 2021. And here we are at the halving. We have to kind of consider that there's a good chance we are pretty much have nothing else that's going to push this price up. That narrative, was kind of the last thing that we have on the agenda for crypto moving forward. I think there's a lot more bad news out there, and we'll get to it in a second when it comes to crypto than there is good news. And I'm not saying that because I'm bearish on Bitcoin. I'm saying this just because, every time we get to this trend line, we get a really good, we get some type of good news, and then we get the rejection right after it in the weeks following. So is it possible that we could get a little push up to 74, 75K? I'm still open to that 100%. I think that especially if the markets rally for the next week or so, I absolutely believe that we could get to 74, 75K. I think there's a good chance that we could sucker everyone back into this market. And yes, I do think that it is 100% would be a bull trap. Now, that being said, after that, there's a lot of things that we have to kind of consider, right? We talk about May being a horrible month for Bitcoin. Well, it's like, 2 weeks from now, May 1st, we're going to be in the month that we've seen major drawdowns. We saw a major drawdown here in May. We saw a major drawdown in May right here. And I believe there was a couple of other ones where we saw major drawdowns in May as well. Or is it right around here? We saw a pretty good move down here back in 2018. So it's not the most bullish month, not by any means. It's May and September are pretty bad months when it comes to crypto and Bitcoin especially. But we also got the 50 moving average very far off from that. And we see how violent Bitcoin does move to the upside. Well, it does the same to the downside. And eventually it does find these moving averages. So I think that we're very, very, very good chance that we could see, some of these gaps that are absolutely open here that were just straight up, euphoric, just do the same thing on the way down. There's some signs that we're also seeing rotation of capital a little bit, right? Obviously, Bitcoin's doing pretty good here. We look at total, it's doing okay. It's coming up a little bit. It's not nothing notable. We're seeing a little bit coming up on total 2 and then total 3, very similar charts. Maybe that's a little bit why we're seeing some of the money come out of Bitcoin. We see dominance go down, and we're starting to see a flow into some of these alts. Like, right, Solana's bouncing a little bit here. BNB obviously is bouncing here, which we don't even need to talk about that bullshit anymore. AVAX finding some support on the 50 moving average. Matic, like these are all doing okay, but for the most part, if we look at this compared to where it was, just a few weeks back, it's a very different story, and nothing's necessarily has changed. So the only thing that I have seen that's changed is just USDT dominance. It's pulled back a little bit, so it tells me a lot of people are getting out of USDT. But what does this also kind of scare me a little bit? Well, the reason it kind of scares me is because we got some news regarding USDT. Now, we've been talking about this for a period of time, but this is just one thing, then I'll get into the Chinese banking, but Venezuela to accelerate cryptocurrency shift as oil sanctions return. They want to pretty much settle trades in USDT. Why is this problematic? Well, this is problematic because this is also USDT, iFinex, which is a Chinese corporation. We know that there's a lot of pressure right now from Janet Yellen in the United States against a lot of these banks that violated these sanction laws with Russia. We also know that Iran has Tether in their country, which is another thing that they're trying to cut down on. So what we're seeing is a lot of, I'm not going to say bad actors or anything like that, but I'm saying actors out there who are using USDT. And if you're seeing the supply kind of go down to dominance, it tells me that maybe people are getting into crypto. Could be that people are trying to get out of it. Maybe that we do get these sanctions at some point. It's kind of a black swan that crypto is facing that we have to kind of tread lightly, when it comes to it. I mean, here's the news. The U.S. is preparing sanctions against Chinese banks for supporting Russia. iFinex, Tether, that is absolutely a Chinese corporation. Tron, a lot of those other ones, they all kind of fall under this, and they're just trying to kind of get oversight into where a lot of this money is pouring in and out of. So seeing that news and again, it comes with a country they already have sanctions when it comes to oil and their regime. It's just problematic for Tether, and if something bad happens to Tether, something bad happens to all of crypto at this point, because we know how much of this move to the upside has been because of USDT, and stablecoins absolutely have helped a lot of crypto find price discovery in the past 8 to 12 months. So I'm very, very cautious looking at this. I think that Bitcoin does have room to run up. I think alts do have room to run up, but I wouldn't get comfortable. Let's put it that way, because I think that there's a lot of things where there's more risk than there is reward, especially with the prices being so elevated up here. And yet at the same time, global tensions and a lot of fears around liquidity are kind of mounting to a point where it's really scary for even the Fed. I mean, the Fed was saying a lot of things like they're, very, I say dovish back in like November, December last year. Now they're kind of turned hawkish publicly, right? That's not the best sign. And eventually people are going to run out of money. We're going to find out a lot of stuff when it comes to earnings as well. A lot of these corporations are already filing for bankruptcy. It just doesn't make a lot of sense where there's going to be money that comes in now that the Bitcoin halving is over, and we're kind of just sitting here waiting for something to happen that's going to push the price up. I don't know if anyone's going to come in and save us. That's the thing.
All right. Who is going to come save us? Probably no one. That, I think, is going to do it for today's show. Appreciate you for joining us, Mr. House, Chris, as always. Appreciate you guys. If you have not yet, hit that like button, subscribe, comment, all that good stuff. We'll be back tomorrow, talk Tesla earnings, the latest economic data that has come out, and anything else that is impacting the financial markets. Have a great day, everybody. Stay safe out there, and we'll see you next time.
Take care, everyone.